Dear Scholar, today we are going to talk about Chapter 12, Long-Term Liabilities. As we have learned in the past, that long-term liabilities has a life greater than 1 year. Means they are not due in a current year, but they are due in more than a 1 year. So the current liabilities that we are going to talk about, there are three kinds of long-term liability: long-term notes payable, bonds, and leases. These are two important topics, and so they have multiple questions in the exam homework and uh, and quizzes. And the leases, you might get one or two multiple choice questions. Okay. So long-term liabilities, the liabilities that do not need to be paid within 1 year or within entity's accounting cycle, whichever is longer. These are reported in the long-term liability section of the balance sheet. So let's talk about it. So here is our balance sheet equation. Asset is equal to liabilities plus equity. Liabilities has two sections: current liability and long-term liabilities. So we studied last time that in current liabilities we have accounts payables, short-term notes payable, unearned revenue, and in the long-term liability we have long-term notes payable, we have bonds, and we have leases. All right. The common long-term liabilities we talk about is the long-term notes payable and mortgages payable. When we are talking about the mortgage payable, it's pretty much like if you own a house, you have a mortgage to pay. That basically a note that you have promised the bank that you will be paying a part of the principal and part of the and the interest that you owe on the whole amount every month, and they will calculate for you. They're using usually a system, or you can use an Excel file to create it. If you Google it, mortgage calculating mortgage Excel file, you should be able to download the entire thing. All you have to do is to plug the numbers and you can calculate your monthly mortgage payment in it. Okay, so what are long-term notes payable? Long-term note payable is similar to short-term notes payable. Only thing is the short-term notes payable has a life less than 1 year, means they due in like 3 months, 6 months, or 8 months. But the long-term notes payable are due, has a life of more than 1 year, and they are not due in the current year. And amortization schedule. What is an amortization schedule? An amortization schedule basically is like a mortgage schedule that I was talking about. It will tell you what day you have borrowed the money, what day you have your first payment, how much your first payment is going to be, and part of the payment, and the payment is divided into two parts. Part of the payment is mortgage interest, and part of the part of the payment is principal. So principal is the amount that you have borrowed and the interest that you have to pay on it. Mortgage schedule, amortization schedule also provides you how much interest that you have to pay on this note. So if it is a 5-year note, that will provide you a list of, so if you are paying every month, so there will be 60 payments, 12 payments per year, 5 years, 60 payments. In every payment, they're going to tell you how much interest you are paying and how much principal you're going to pay. Your payment, it's 99% is going to be the same for the entire 60 payments for the 5 years. But the amount of interest and principals are going to change. So initially, the large chunk of your payment, it will be interest, and a very small will be principal. But as you going further down, your principal amount will increase and your interest amount shrinks. So that's basically an amortization schedule. The picture of an amortization schedule has been provided in your textbooks, and you can look at it there. Details each loan payments allocation between principal and interest with the beginning and ending balance of the loan. Interest is computed as the beginning balance multiplied by the interest. So basically the beginning balance is the principal, multiply by the interest rate. So it's interest rate multiply by the time. So time is how many times you have to pay. So basically it's in 5 years. So 5 years it's going to be every month. So based on the 5 years, if we can divide the 5 years, basically 60 payments. So that is basically the interest that you are going to calculate, and that formula is also provided. So for suppose you are borrowing 100,000 at a 6% rate for 5 years, what will be your interest is going to be. Okay. Now mortgage payable is also called bonds. A bond is basically a contract. So when you are purchasing a house, what you are doing, you are purchasing a house which is already been used. So suppose Adams is a guy who is selling a house, and you are buying this house. So you do not have $500,000 to pay Adams right now. So you're going to engage a bank, and a bank is going to pay $500,000 to Adam, and you and Adam are done because Adam got the $500,000, and the Adam is going to give you the possession of the house. Now the deal is between you and the bank. The bank, now you owes the bank $500,000. So the bank is going to ask you to make a monthly payment, and the bank is to give you, okay, you owe me $500,000. I'm going to charge you say 8% interest, and based on the 8% interest, it's going to be that much interest over the 30-year period or 15-year period, whatever you are financing it. And then they will tell you what would be your payment for each month, and the each month payment is going to be fixed. And just like in notes payable, long-term notes payable, we talked about, in the bonds, initial payment has more interest, money going towards interest, and less money is going towards your principal, and then it continues to goes down. The interest, part of the interest increases, and part of the the interest is shrinks with it. So it works in the same way. So that's how the mortgage payable is work. So bond is a contract. Where this idea of the bond comes from, so let me tell you something. So borrowing, it's a very old age tradition in our society. People have been borrowing money for thousands of years. But usually what happens, people do not need larger sum of money like in today's business. So in the past, they need a small amount of money that they can borrow from a money lender. And the money lender usually takes something as a collateral. It could be the paper of your land or paper of your house or anything of value. And they give you the money, and they tell you that how much will be the interest, and basically you pay them back. But what happened as the world expanded and the businesses grew, they need more money. The problem with one person lending is that when a borrower default on the loan, the lender has to suffer all the losses or face all the losses. So the modern finance came up with a novel idea. They say that what if we have many lenders for one borrower? So they came up with the idea of the bonds, and the idea was that we're going to distribute the risk of default on many people. So how they usually do it, for example, you are a business and you need $100 million. What they're going to do, take this $100 million and they divide it with a $1,000 pieces of it. So how many pieces you going to get? When you have $100 million, you will get 100,000 pieces. So you have 100,000 bonds, and each bond equals to $1,000. So what's going to happen here, that they are going to find 100,000 people who are willing to buy these pieces. So one person has to buy one bond, but a one person can purchase more than one bond if they can afford to do that. So for example, if you have $1,000, you can buy one commercial bond with a face value of $1,000. But if somebody has $10,000, they can buy 10. And if somebody has $100,000, they can buy 100 bonds. So this way, the risk is distributed among many people. And if, for example, the business who is borrowing this $100 million defaulted on this loan, means unable to pay back the loan, then these people, theoretically speaking, if everybody is holding a $1,000 bond, so that means it will give them they're only going to lose $1,000. And in today's world, it is very easy for a lot of people to absorb the loss for $1,000 compared to losing $100 million for one person. So that's the idea behind the bond. This $1,000, they came arbitrarily. So it could be $10,000, but $1,000, that's the amount they came traditionally about 100 years ago, and they still do the $100,000. The face value is the amount a borrower must pay back to the bondholder on the maturity date. So what is a maturity date? When the principal is due back, when the principal is due. So for example, if you are borrowing this $100 million on October 1st, 2023, and you said you are borrowing for 10 years, so that means you will return this money on September 30th, 2033. Okay, so this is the maturity date. So this is the maturity date of September 30, 2033. This company who is borrowing $100 million will have to give back $100 million back to the bondholders. Okay, the maturity date is the date on which the borrower must pay the principal amount to the bondholder. The stated interest is the interest rate determine the amount of cash interest the borrower pays. What does it mean? So stated interest or face interest is the same thing. So on the face of the bond, it says, for example, I am going to pay 5%. That means every year, a person who is holding a $1,000 bond will receive $50. So it is a 10-year bond. So for the next 10 years, he will receive $50 every year at the end of the year. And at the end of the 10th year, he will receive his $1,000. So if this is what you like to do, you can do that. So they will give you 5%. So that's the idea about face interest. So a couple of things that you have learned in this. There is a face value. So the face value is this $100,000, or the face value you can say also is $1,000. So this is a total amount they were borrowing, and the $1,000 is the face value of the bond. Also, the maturity date is this date, and this is the beginning date or initial date when the bond was floated. And the stated interest is on the interest that is on the face of the bond written in an agreement that you will receive 5% interest every year. There are some type of bonds such as term bonds, serial bond, secure bonds, and debentures or unsecured bonds. Term bonds are bonds that mature at the same time. So for example, this bond, the initial date was 10/1/2023. So their maturity date, all bonds will be matured on September 30th, 2033, and all mature at the same time means they will be returning the principal amount on this date. Serial bonds are bonds that mature in installments at regular interval. So for example, they are borrowing $100 million and they say is that every year they're going to give back $10 million. So every year $10 million. So that means they will be returning your money not at after 10 years, but every some money or 10% of the money. And so if you're holding one bond, they will give you back $100 plus the $50 interest that you have earned at the end of the first year. Secure bonds are bonds that give bondholder the right to take specific assets of the issuer if the issuer fails to pay principal. So the person who is borrowing the money is the issuer. So secure bond is, let me give you an example. There are two kinds of loans in the world, or two types of borrowing, secure or unsecured. So when you are purchasing something on your credit card, credit card loans are considered unsecured loan. But when you are purchasing a car, that is a secure loan, because if you do not make your car payments, they're going to repossess your car. When you are purchasing a house, it is also a secure loan. If you do not make a payment to your house or mortgage payments, they're going to evict you from your repossess your house. Bond features: there is a call provision that allows the issuer to redeem the bond prior to the maturity date. It simply means, call provision simply means the person or the business or the entity that borrows the money, they are calling back their loan. Means suppose they borrow it for 10 years, $100 million, but after 5 years they realize they have enough cash to retire this bond, so they will call it and consider it retired. Means they give everybody their money they owe, and there will be no more interest payments after that. A sinking fund. A sinking fund is a fund that is created where the borrower will put a certain or fixed amount every year into a bond. So for example, this company who is borrowing $100 million would probably require to put say $10 million every year at the end of the year into a sinking fund. And the sinking fund is a sort of a fund, once the business put the money, they cannot take it back. So a third party probably keeping track of all this, and that third party, once the sinking fund is full of like $100 million at the end of the 10 year, they will make the payment on behalf of it. Sinking fund or secure is usually considered when the borrower is has a higher risk of default. They usually have sinking fund to cover that risk. Okay. Bond prices. A bond can be issued at any price agreed upon by the issuer and the holder. Issuer is basically the borrower. Bondholder is the lender. Or the issuer is the one who is selling the bond, and the lender is buying the bond. Okay. A bond can be issued at face value, at discount, or at premium. So what is the face value? So face value we have already talked about is $1,000. So face value is $1,000. If a bond is sold for greater than $1,000, it's called we are selling at premium. And if a bond is sold for less than $1,000, it's called selling at discount. Okay. Bonds are usually sold in the unit. So discount on the bonds occur when the issue price is less than face value, and a premium on the bonds occur when the issue price is above the face value, like I show you here. Bonds are usually sold in the units of $1,000, although the price paid may be more or less than $1,000. market interest rates relative to the interest rate paid on the bond is the major determinant of the bond's issuance price. This part is very important. So how we do that? Let me show you. So suppose Adam is borrowing $10 million. 10 million. So 10 million is written as this. And face interest or stated interest is 5%. And the life of a bond or duration of the borrowing is says it's 5 years. So they are borrowing. So the issue date, the date they are borrowing is, suppose issue date is October 1st, 2023. So what would be the maturity date? Maturity date would be 5 years from this date. So that would be September 30th, 2028. All right. So what is the face value of the bond? The face value is $1,000, but in this case the principal is $1,000, but the principal, the amount, total amount we are borrowing is $10 million. Okay. So when you are borrowing $10 million, right? So how many number of bonds you are selling? Number of bonds, the number of bonds you can calculate is 10 million divided by $1,000. So how many bonds you are selling? 10,000 bonds. So you are selling 10,000 pieces of this $10 million is $10,000. However, the market rate is 6%. So what is going on? You are saying that I want to borrow money, which is $10 million, but I will pay you only 5%, right? So, and the market rate is 6%. So you have a choice. If you put this money in Bank of America, the Bank of America will give you 6%. So suppose you put $1,000 in Bank of America, the Bank of America at the end of the year will give you $60. But this gentleman, Adam, is saying, I will give you 5%. So how he going to convince you to buy his bond and not to put money over there? So he's going to sell you the bond at a discount. So he probably sell you a bond, say at $950. So the sell price is equal to $950. But when he's going to return, so sell price on October 1st, 2023. But the maturity date on the September 30th, 2023, he will give you $1,000. So today he is asking $950, but he will give you $1,000 for a bond. So basically he has to sell this at a discount to lure you into buying his bond, because the market is selling and the market is offering 6% interest. So this is the reason, this is an example. So bond selling at a discount. Now, what if the market rate is equal to 4%? And now you are offering 5%. So you're offering more than the market value. When you do that, your selling price would be approximately equal to $1,050 on 10/1/2023. but at maturity date on September 30th, 2028, you will be giving the bondholder only $1,000. So he is getting $50 more on this day, but he will receive only $1,000. Here at discount, he is only paying $950, but he will receive $1,000. Okay. So that's the idea behind market rate determines the calculation of the selling price of the bond. If the market rate and the stated rate both, so the last point is if the market rate is equal to face interest, then the bond is selling at face value. So you purchase at $1,000 on this date, on October 1st, 2023, and when you sell it on September 30th, 2028, you will receive another $1,000. So there'll be no change. Now, what is a premium and what is a discount? A discount is basically you selling at a less, so it's a loss, and a premium you getting more money, so it should be a what a gain. But a gain is always a point in time. Premium, sorry, a gain is a gain is a point in time, and a loss is also point in time. But this gain and this loss is recognized over a period or the life of the bond. Therefore, we use the term premium and discount instead of gain or loss. All right, let's move to another topic in the bond valuation. The selling price of bond is a function of bonds cash flow. So what are bonds cash flow? All right, so suppose today you borrow, you purchase a bond. When you are purchasing a bond, you are paying $1,000. But what you receive in the future? So at the end of the year, every year, suppose if you are selling it, you will receive $50, $50, $50, $50, $50 for the next 5 years at the end of each year. And at the end of the 5th year, you will receive your $1,000 back. So these are the cash flow a bond holder or the purchaser of the bond will receive. And this bond cash flow will be considered or will be calculated using market rate. So the next thing we're going to talk about an annuity of interest payment. So what is an annuity? When you receive each period, each year, each month, each quarter, the same amount of money, we call this an annuity. Okay. A future lump sum principal payment. So we want to know what would be the future lump sum. So the future payment here that you will be receiving is $1,000. Okay. Add the present value using the bond's effective interest rate of these two amounts to compute the bond's selling price. Let me show you. We're going to use the example that we have in the previously we have used. So the face value is say $100,000. Face interest is 5%. Market interest say is 6%, and a life of a bond is say 5 years. Interest is paid annually. All right, so let's say how much interest we are going to pay. So the interest is a function of time, so we borrowing 100,000 sorry, 1,000. So each bond is $1,000. Okay, so interest is going to be 100,000 multiply by 5% face interest, 5 over 100, and we're going to provide every year, so it's 12 over 12. So this 0 is cancelled by this 0. So how much we left? So this is cancelled. So 1,000, 5,000. So you have to pay $5,000 for borrowing $100,000 at a 5% interest to the bondholders. All right, so we have to pay. So we have to pay year 1, year 2, year 3, year 4, and year 5. And in year 5, I'm going to write down twice. So the first year you will be paying $5,000 for the interest. Second year you're going to pay another 5,000. Third year you're going to pay another 5,000. Fourth year you're going to pay another 5,000, and the fifth year you're going to pay another 5,000. But you also have to return this $100,000 at the end of fifth year as well. So these are called cash flows. Now we have to calculate, because we are sitting over here today. So this is our today. So we are calculating the price of bond as of today. So the price of bond is equal to these cash flow, but we have to discount these cash flow at a 6% interest. So how are we going to find out? So this is our annuity. All right, and this is our single payment. Okay, so if you look at the okay, so annuities, I'm going to give you one more thing about annuities. There are two kinds of annuities: ordinary and due. Ordinary annuity means due at the end of the period. That's the definition of ordinary. The due means due at the beginning of the period. These we use for bonds, and these are used for some of the lease payments. All right, so what we are saying, that since interest is a function of time, a time has to pass before the lender can earn the interest. So that's why we use ordinary annuity for the bond calculation. So we look at the bond calculation. So we look at the annuity factor. So we're going to look at ordinary annuity factor, and the factor is we have a 5% and 5 year. All right, so when we are looking for 5 year and 5%, we're going to find out there is a table. It's called annuity table, and in the under this annuity table, 5% for 5 years, we will find out a factor, and I am going to show you how a annuity table look like. So an annuity it looks like this. So this is a present value of ordinary annuity. So we're looking at 5%. So you know this is a 5%, and years are on this side, or period on this side. So this is 5 year. So we're looking at the intersection of these two number, 5% and 5 year, and we will find a number 4.32948. So we're going to take 5,000 and multiply by 4.32948. Then we're going to plus, and we have to take into consideration $100,000. And when we look at, we have to look for another Now I'm going to show you another table which is present value of $1 or one payment over here. So we're going to have the same thing. So we look for 6%, and we're going to look for 5 years. So you notice is 0.747, 0.74726. I think I made a little mistake here. Instead of using 6%, so it's not 5%, it's going to be 6%, and it's going to be 5 years. So instead of this number, we're going to use this number, 4.212, 4.21235. So when we do that, we have this number available to us, and we take this number and we multiply both numbers using a calculator. So when we take 5,000 and multiply this number, 5,000 multiplied by 4.21235, and we get 21,061.75, and then we take 100,000 and multiply with 0.74726. It gives us 74,726, and then we add these two numbers. Is $95,787.75. So this is the price of bond, and as you can see that the face value of the bond is 100,000, and we are selling for price of a bond is 95. So we are selling at a discount because the face interest we are offering is 5% and the market is offering 6%. So the discount of a bond is equal to face value minus price of bond. So face value is 100,000. The price of bond we have calculated is 95,787.75. So this discount turns out to be $4,212.25. So that is how we discount of a bond is calculated. Okay. Let's talk about a little bit more on this one. And I'm going to show you a couple of other things. The effective interest method is required by GAAP unless the straight line method produces immaterial differences. In this chapter, the questions that you are going to receive will be based on a straight line method, not on effective interest method, because it's an introductory class and I do not want to create so much trouble. So how the straight line method works, it's very simple. So a straight line discount amortization is going to be 4212.25 divided by over the 5-year period. So that turns out to be $4,212.25 divided by 5. It's $842.45. That's how we're going to calculate. Okay. The effective interest is the market rate of interest used to price the bond when it is originally issued. That's something we just did it. The effective interest method of interest amortization recognizes a constant percentage of the book value of a bond as interest expense for each interest payment period. So for example, I'm going to show you one more thing. So here is a price of bond. Price of bond, also called present value of bond. So for example, on this day, we calculated the price of the bond is $95,787.25, I believe, 75 cents. And the discount on bond is equal to $4,212.25. Right? So that's the idea behind it. And the difference between calculated interest expense and actual interest paid represent the amortization bonds of a discount premium. So you are paying every year, how much interest you have to pay? $5,000. If you take the $5,000 and you subtract 4212.25, you will get 5,000 minus 4212.25, you will get $842.45, the same thing that we have calculated earlier. Future and present value of the money. So this calculation of the price of bond is the present value of bond. So it is called price of bond. It is also called present value of the bond, and it's also called the current value of the bond. So price of the bond, present value of the bond, and current value of the bond is the same thing. Okay. The time value of money is the recognition that the money earns interest over time. As I said before, interest is a function of time. The more time passes, the more interest you are going to earn. So basically, when we are lending the money, we are basically renting our money, and interest is a sort of rent that we are receiving for our money. Okay. The present value is the amount a person invests now to receive greater amount in the future. And the future value of investment at the end of the specific time frame. So bond interest rate, the stated interest rate is this printed on the bond. So if you look at the bond certificate, it looks like this. It has a face value of say $1,000. So that's the face value. It will have a face interest of say 5%. It has an issue date, so it's 10/1/2023. So that's the issue date. It may have a life of a bond that is issued for 5 years, and it may tell you whether you're going to receive the interest what we call it, a monthly basis, quarterly basis, half yearly, annual, a semi-annual basis, or annual basis. Okay. Issuing bond versus issuing a stock. So this is always a very important question for a lot of business. So every time a business wants to borrow money, should they issue a bond or should they issue a stock? So the difference here, when you issue a stock and you sell your stocks, you get the money, right? And the stockholders cannot force you to pay them dividend. It's the company prerogative every time or whenever they want to pay the interest. But the problem with the bond is the borrower is required to pay the interest as promised. If they do not pay the interest to the bondholders, the bondholders can take you to the court to get the interest. However, when you pay a dividend, you cannot deduct the dividend from your it's not an expense, so you cannot deduct it in the income statement. But when you pay an interest can be deducted as an expense, so that helps you increase your profitability. So these are the issues with the bond and the stock. A stock is part of your equity and the bond is part of your long-term liability, so it increases the liability of a company. Okay, so we have just completed an example issuing a bond at a discount. So discount on is a contra account to the bonds payable, which I have shown you by two T accounts. Bonds payable minus the discount gives the carrying amount of the bond. Carrying present value or price is the same thing of the bond. Issuing bond at a premium is just the opposite. When the stated interest rate is greater than the market interest, the bonds are sold at a premium. And premium on bonds payable is an adjunct account to the bond payable. An adjunct account is an account that is directly related to another account. Okay. How do we record? So when you are issuing the bond at face value, you say debit cash, the cash that you're receiving. This is, okay, so who is recording the bond issue? By the borrower or the bond issuer is the same thing. Okay, so if Adam is borrowing the money, he would say debit cash and credit bonds payable. So what he's saying that this $1,000 came into my business is because I'm selling a bond worth $1,000 and I am required to pay or liable to pay at some point this money. When you are recording the bond issue at discounts, you're receiving less cash. So you say debit cash 970 or 950, and you say debit discount on bonds payable $30, but you have to pay $1,000. So today you're receiving a $970, but you will be end up paying $1,000. When you are recording the bond issuance at premium, you're receiving more cash, $1,050. So you credit a bonds payable for $1,000, but you will resend bonds payable at $1,000, but the premium on the bond is $50. So you have to return, you're getting $1,050, but you're paying $100,000. Bonds maturing in over a year appear on the balance sheet as long-term liabilities. The discount appear as a reduction of the liability, and premium appears as an addition to liability. Okay. This is, I show you bonds payable is 1,000 less discount is the net book value of the bond or the carrying value of the bond. And the bonds payable if $1,000 at the premium $50, so net book value is 1,050 or the carrying value is 1,050. What are the advantages of the bond? Is no ownership. Interest dilution means nobody can claim. Bondholder can only claim their money and interest. They cannot claim that they are the owners of the firm. So they are only the creditors but not the owners. Bond expense is tax deductible that I have showed you. Unlike dividends are not tax deductible. Income to common shareholder may increase if the firm can earn more on the use of the borrowed fund than the cost of these funds. This is known as a bond, is also known as leverage. What are the disadvantages of the bond? Bond interest, unlike dividend, is a contractual obligation, means you must be paid. Funds borrowed have a specific repayment date, unlike funds received from the issuance of common stock. So when you are selling the stock, that stock can be sold back millions of times, but you do not have to pay them anything. You have to pay them only when you call the stocks and say, I'm going to retire these stocks. Borrowing agreements may restrict company actions, means they may have to have a sinking fund. These restrictions are called debt covenants, and these debt covenants are written in that contract called bonds. Retirements of the bond. Retirements of bonds involves paying the face value of the bond. So just like I talked earlier that you can call the bonds. So yes, you can call and you retire the bond if you have the money. Bonds can be retired at maturity date or before. And in the previous example, I say if it is a 10-year bond and you want to retire, pay off the principal, you can do that. But that information should be included in the contract of the bond when you're borrowing this money. When a bond is mature, the carrying value always equal the face value, whether you sell the bond initially at discount or premium. It does not matter. Whether you sell at discount or premium, at the end, the carrying value will be equal to carrying value is equal to the price of the bond. Retirement of bonds before maturity. Companies sometimes retire their bonds prior to maturity. The main reason is to relieve the pressure of paying interest payments. They don't want to pay the interest payments and they say, let's just call it off. Some bonds are callable bonds, means they have the borrower have a right to call the bonds, which means the company may call or pay off the bonds at a specified price. Retirements of bonds before maturity. To retire before maturity, record partial period amortization of discounted premium and partial period interest payments. If the retirement does not fall on interest payment date, remove the portion of unamortized discounted premium that relates to the bond being retired. Debit bonds payable at face value, credit a gain or debit loss on retirement. So for example, you have a bond you want to retire, you're going to say debit bonds payable, and you're going to credit cash. And if you have a discount, for example, you're going to say debit credit discount on bond, and then either you're going to have a loss on retirement, either you're going to have this or gain on retirement. So either you're going to have a loss on retirement or you have a gain on retirement. So that's a credit. Okay. Report liabilities on the balance sheet. At the end of each period, all current and long-term liabilities are reported on the balance sheet. When a company issues a bond, a discount or premium is included in the section with the bonds payable, like I show you on a previous page, that you put the bonds payable and right next to it either a bond discount or bond premium. Time value of money, you can read it at your own leisure. There will be probably not very many questions on the bond, on the present value of the bond. Okay, we have already talked about the present value of the bond payable. Example of bond valuation. While bonds can be a good investment of choice, there are also some disadvantages to consider. These disadvantages include lower potential return. Right now the interest rates are very high, so people are getting 5, 6, 7%, but when interest rate is low, you do not get as much return. Interest rate risk. So if interest rate goes down, you may lose, or interest rate goes up, because the price of a bond is based on market interest rate. Inflation risk. Right now we are in high inflation in the last year, so inflation basically eats up your return. There is always a risk that bond may default in case you lose all your investment. Liquidity risk means less liquid, meaning they're difficult to sell quickly at a fair price, or you may not get your interest payment. Market risk. Value of bond can be affected by changes in the broader market. Now we're going to talk about leases. Rather than purchasing an asset, company may rent or lease the asset for a specified period of time. So when you are leasing, the owner of the property is called the lessor. So for example, you are leasing from Best Buy. So Best Buy will be considered a lessor, and the person who is, so Adam, for example, in our case, is leasing, it will be called a lessee. And it provides you the right to use the property are called leasehold. For example, if you go to a lawyer's office, in the lawyer office you may see a computer network, a printer, a copier, a scanner. Majority of the people who are starting their practice, they do not buy, they don't have that much cash, so they lease. In this lease, they have to pay a monthly payment like a rent for these equipments to use. What are the types of lease? There would be so remember, the questions that you're going to get is to a definition of a lease and type of the lease. The accounting treatment of the lease depend on the type of the lease. A capital lease, there will be a question about a capital lease. Transfer to the lessee substantially all the benefit and risk related to the ownership of the lease asset. The lessee records an asset and a liability. The lease payment is debited to interest expense and the lease liability. The lessee also records depreciation expense. An operating lease, on the other hand, occurs when the lessor retains the usual risk and rewards of owning the lease. So it's very much like rental payment, and you report this on the income statement. For capital lease, it's like the ownership, and you report this on a balance sheet. The lessee does not record an asset or a liability. The lessee payments are debited to lease expense. Okay. Capital leases. Lease is considered to capital lease if at least one of the following criteria is met. Otherwise, lease is considered an operating lease. The lease transfer ownership of the property at the end of the lease term. Transfer of ownership. The lease contain a bargain purchase price for the end. So for example, if you are leasing a car and you are using a car, leasing it for 5 years, usually the life of a car is considered 5 years. So you are basically leasing for 100% of the time. And if there is a bargain purchase that, you're leasing a $40,000 car, but at the end of the 5 year, you may purchase that car for $15,000. The lease term is at least 75 of the remaining estimated life of the lease asset. So the car is considered 5 year and you are leasing it for 5 years. That means you are leasing it for the 100% of the time. If a life of a car is 8 years and you are leasing a car for 6 years, so that means you're 75% of the time. So it will be considered a capital lease. The present value of the lease payment is at least 90% of the lease asset fair value. If all the lease payment, if you take the present value, is greater than 90% fair value, then in case it's either of one of them, it's or among all of them, or. If just one of them are true, then it's a capital lease. But these things apply on a business, not an individual. If you are leasing a car as an individual, these things does not apply to you. But if you are leasing a car as a business, then it does apply to you. Okay. Thank you very much for watching this video. Please let me know if you want me to make any changes to these videos. Also, please make sure do watch the videos that comes from your publisher, and also the video where I have solved an entire question on bond for you to watch. So please make sure you watch all the videos in order to get the benefit of all the videos that all the material that you have to cover for this chapter. Again, thank you for watching this video. I hope to see you in the next video.